It's Wednesday, 28th of January, 2026. Welcome back to your news update on blip brief, crisp, but almost everything updated every weekday.
And we are jumping straight into a market session that can only be described as schizophrenic.
Schizophrenic is the right word. If you looked at the Indian indices today, you saw two completely different realities.
They're playing out side by side.
It was a split decision, literally. The Nifty managed to, keep its head above water, climbing steadily.
But the Sensex looked like it was wearing cement shoes.
It faced serious downward pressure. This wasn't a rising tide lifting all boats at all. It was a very, very selective rally.
It was sector rotation in overdrive. You have to look at who was doing the heavy lifting for the Nifty.
It was the old economy giants, right?
Financials and metals. They practically dragged the index into the green by sheer brute force.
Axis Bank was leading that charge. It surged over 5%.
Over 5%. That is a massive move for a large-cap bank in a single session.
And Adani Ports wasn't far behind, up about 4.5%. It feels like the market is betting heavily on infrastructure and, well, credit flow.
That's the risk-on trade. And it wasn't isolated. Tata Steel and Tech Mahindra both locked in gains of roughly 2.7%.
When you see steel and banking moving in lockstep like that, it usually signals the market expects capital expenditure cycles to speed up.
Precisely. But here is where the split personality kicks in.
Right. While the banks were partying, the auto sector was getting absolutely hammered.
Hammered might be an understatement. The auto index hit a brick wall.
Mahindra and Mahindra took the worst of it, dropping over 4%.
And you also saw heavyweights like Kotak Mahindra Bank and Asian Paints sliding, down roughly 2.6 to 2.7%.
So this brings us to the why. This drop in autos, it isn't just random profit booking, is it?
No, not at all. It feels like a direct reaction to policy.
It is entirely policy-driven.
The market is efficient. It prices in news instantly. And the news that broke over the last 24 hours about the India-EU free trade agreement, that's the smoking gun.
Okay, we need to unpack this because headlines are calling it the mother of all deals.
Well, for some, maybe. But for Mahindra and Mahindra's shareholders, it looks more like the mother of all headaches.
It's a double-edged sword, then.
It is. India and the European Union have finalized a historic free trade agreement. And when we say historic, we mean a complete restructuring of tariff lines.
Okay, let's start with the pain point. The reason autos crashed. We are talking about import duties on European cars.
Plummeting. Correct. For decades, India has shielded its domestic auto manufacturers with, well, a fortress of tariffs.
Triple digits, around 110% on imported vehicles.
Exactly. Under this new deal, those duties are set to be slashed down to just 10%?
Hold on. From 110% down to 10. That is virtually erasing the moat.
It is.
But surely there's a timeline here. They aren't dropping the gate tomorrow morning, right?
There is a transition period, yes, but markets are forward-looking. They're pricing in the future reality today.
So if you're a domestic manufacturer, suddenly your pricing power on, say, premium SUVs is threatened.
It's completely threatened. A luxury German car that used to cost double because of taxes is suddenly going to be price competitive.
So the market is pricing in a margin squeeze. They expect Indian players will have to lower prices to compete.
Which eats directly into profitability. Precisely. The days of price protection are numbered.
But we have to look at the flip side.
Of course. While autos take a hit, the export sector is popping champagne.
This is the textile and chemical story.
It's a massive unlock. Tariffs on 99% of Indian exports to the EU are going to zero.
99%.
We are talking about apparel, chemicals, footwear sectors where margins are, razor thin.
And that's crucial because India has been losing ground to Vietnam and Bangladesh in exactly those sectors.
Right. Vietnam has had a trade advantage for years. This deal effectively neutralizes that.
So if you're a textile manufacturer in Tirupur, your goods just became significantly more attractive to a buyer in Berlin or Paris.
That 99% tariff elimination is a direct injection of competitiveness.
And for the consumer, I thought something about chocolate.
The sweet spot of the deal, literally. European consumer goods, specifically chocolates from Switzerland, Belgium, and Germany.
They're expected to drop in price by 50% on Indian shelves.
By half. It's going to change the game for the urban consumer.
But stepping back from chocolate and cars, there's a huge geopolitical signal here. This deal has been in limbo for years. Why close it now?
Think about the timing. We have a new administration in the U.S. President Trump is back in the White House.
And the rhetoric is protectionist.
So this is a hedge.
It's a strategic hedge. The EU is effectively looking at India and saying, we need a reliable partner.
And India is looking at the U.S. trade walls and saying, we need to diversify. It's a classic case of strategic autonomy.
While the U.S. turns inward, Europe and India are building a corridor.
Speaking of that, we noticed something a little alarming on the dashboard today. The volatility index, the India VIX.
A fear gauge.
Despite the nifty climbing, the VIX spiked 22% in just 5 sessions.
That's a huge divergence. Usually when stocks go up, fear goes down.
Which tells you that smart money is nervous. They are buying stocks, but they are also buying insurance.
They know that with this new trade deal and the chaos in the currency markets, which we'll get to, the ride is about to get bumpy.
Indeed. Let's talk about that corporate resilience, though. Earnings season is still rolling, and we had some interesting numbers from telecom.
Vodafone Idea, a glimmer of hope.
It is. Net losses narrowed sequentially, and revenue inched up 1.1%.
Now, 1.1% doesn't sound like a revolution, but in the context of the telecom duopoly, just staying alive is a win.
It's about the quality of the revenue. They are finally managing to retain their 4G user base while shedding the low-margin 2G users.
It's not just about stopping the bleeding.
It's about sanitizing the wound. They're stabilizing the average revenue per user, the ARPU, which is the only metric that really matters in telecom right now.
Meanwhile, the FMCG sector seems to be benefiting from the deflationary trend in commodities.
Marico and Tata Consumer Products posted strong growth. Marico's revenue grew 27%, and Tata Consumer was up 15%.
But don't just look at the sales figures, right? It's about the margins.
Exactly. The cost of inputs, copper, tea leaves, packaging is softening.
So they aren't necessarily selling that much more stuff. They are just making more money on every unit they sell.
It's a bit of both. They are using grammage adjustments, giving you a little more product for the same price to drive volume, while the lower input costs protect their bottom line.
A sweet spot for FMCG.
Then we have a massive industrial comeback. Boeing.
Sales skyrocketed 57%. This is a supply chain story.
For years, Boeing had planes sitting on tarmacs waiting for engines or seats. Those bottlenecks are finally clearing.
Which feeds into the demand for travel. But here's the industrial story that really caught my eye.
The Adani Group tying up with Brazil's Embraer.
This is significant. They're setting up an assembly line for commercial aircraft in India.
Now, we have to be clear. Assembling a port crane is one thing. Assembling a commercial jet fuselage.
It's a different universe of engineering precision. This isn't pouring concrete. It's high-stakes, highly regulated manufacturing.
Absolutely. The certification barrier in aerospace is the highest in the world. But that is why this is such a pivot.
Adani is moving from infrastructure operation to high-tech manufacturing.
And Embraer makes regional jets, which are crucial for connecting Tier 2 and Tier 3 cities. If Adani can pull this off, it changes the perception of Indian manufacturing globally.
It pushes Make in India from a slogan to a very complex reality.
But while India builds planes, the global macro picture is looking incredibly fragile.
The U.S. dollar is in freefall.
It plunged to a 4-year low against major peers, and the catalyst came straight from the top.
President Trump explicitly stated he is comfortable with a weaker dollar.
This feels like the Lighthizer doctrine coming back into play. Devalue the currency to boost American exports.
That the Federal Reserve usually fights that kind of talk. Are we looking at a standoff?
We might be. A weaker dollar makes U.S. goods cheaper for the world, which helps the Rust Belt. But for the rest of the world,
it's chaos, and specifically for India. If the dollar is weak, that is bad news for our IT giants.
TCS, Infosys, they earn in dollars. If the dollar buys fewer rupees, their reported earnings take a hit.
That is the immediate second-order effect. You might see the IT index come under pressure if this dollar weakness persists.
It's not just currency, it's trade threats, too. Trump is threatening to hike tariffs on South Korean goods to 25%.
Citing legislative delays. But think about the supply chain contagion.
South Korea is a hub Samsung, Hyundai, LG. If their goods get hit with a 25% tariff entering the U.S., that shockwave hits their suppliers everywhere.
Vietnam, China, and India immediately. It creates a climate of uncertainty where no contract feels safe.
And adding to that anxiety is the immigration crackdown.
Specifically in Texas, the governor banned state agencies from sponsoring new H-1B visa petitions.
The Texans' first agenda.
Exactly. And while it only applies to state agencies right now, the signal it sends is chilling for the Indian professional diaspora.
It suggests the environment for skilled migration is hardening at the state level.
So we have a weak dollar, trade wars brewing, visa bans. In that climate, where does the money go?
It goes to the bunker. Gold was up 1.6% today, the classic safe haven.
But let's look at silver. We have a weird signal there. The gold-silver ratio hit a 14-year low.
This is a technical nuance that really matters. Usually, silver trades somewhat in line with gold.
As a precious metal, right?
But when that ratio drops this low, it tells you the market is ignoring silver's money properties and treating it purely as an industrial metal.
Because silver is used in solar panels and electronics.
Correct. The market is betting on industrial demand for silver, likely driven by the green energy push, rather than buying it for safety. It's decoupling.
And there's a massive arbitrage opportunity right now.
A huge one. Silver is trading 17% cheaper in India compared to China.
17%. That is massive. Way a gap.
It suggests an immense localized demand squeeze in China, likely for their solar manufacturing dominance, that simply doesn't exist in India yet.
So traders will be looking to close that gap.
For sure. But right now, it just shows how fragmented the global commodity market has become.
All right, let's pivot from the volatility of the present to, well, the certainty of the future. We have an innovation spotlight today that claims we have reached a transistor moment.
This is big. Scientists are declaring that quantum technology has officially passed its transistor moment.
I love that analogy, but let's make it real. The transistor replaced the vacuum tube.
Right. Vacuum tubes were hot, unreliable, broke all the time. Transistors made chips scalable.
So are you saying quantum is finally scalable?
That is exactly it. Until now, quantum computers have been like those room-size vacuum tube machines, noisy, error-prone.
And requiring conditions so specific they were barely functional. They relied on physical qubits, which are incredibly unstable.
Yes, a slight change in temperature and the calculation just collapses. The breakthrough now is the successful demonstration of logical qubits that work with error correction.
They've figured out how to make the system stable enough to actually run algorithms without crashing.
So we are moving from physics experiment to engineering problem.
Exactly. And once it becomes an engineering problem, you can iterate, you can miniaturize, you can scale.
This is the starting gun for industrial application.
So what does a scalable quantum computer actually do for us?
It solves problems that are currently impossible for classical supercomputers.
Like nitrogen fixation.
Perfect example. The Haber-Bosch process for making fertilizer consumes a massive percentage of the world's energy.
A quantum computer could model the molecular breakdown to find a catalyst that does it at room temperature.
That solves food security and energy crises in one go.
Or protein folding for drug discovery.
Exactly.
Yeah.
Simulating how a drug interacts with a virus at an atomic level in seconds, not years. If this transistor moment is real, we are standing on the edge of an exponential leap in human capability.
It's the difference between the abacus and the iPhone.
And we just figured out how to build the silicon chip.
That is a fascinating, if slightly mind-bending note to end on. From the gritty reality of trade tariffs to the atomic potential of quantum computing.
It's all connected. It's all about adaptation.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.